Hello everyone, Juan here, and in this video we're going to cover the introduction to derivatives. So what is a derivative? It's actually a financial security whose payoff is linked to another previously issued security. Now, derivatives are actually used for leveraging of returns, or what we call speculation, and reduction of risks, or what we call hedging. Now, the common types of derivatives are spot contract, we have the forward contract, and futures contract. So what is a spot contract? It's actually an agreement to transact involving the immediate exchange of assets and funds. Now, usually it takes up to 2 business days. Now, for example, we have here, let's say you are an importer and then you wanted to import corn and the cost of the transaction is $100,000. Now, on March 1, for example, the dollar peso exchange rate is at 48.50, and you anticipated that it will go up on the next few weeks to up to 49.20. So, in this case, you can enter into a spot contract, and that will give you the privilege to buy dollar at 48.50 even if the exchange rate would go to 49.20 or even higher. So here, if you're going to look at, you have $100,000 transaction and the total obligation that you need to pay to your supplier is 4,850,000 pesos. So the spot contract prevented you to incur losses brought about by the increase in foreign exchange rate. Now, how about a forward contract? It's actually an agreement to transact involving the future exchange of assets and funds more than 2 business days. Now, in this example, what if you are an exporter of bananas and then you have a $100,000 transaction? And during March, you had the foreign exchange rate dollar to peso at 49.20, and you actually anticipated that the forex would go down to 47.80. So in this example, in order to lock in that 49.20 exchange rate, you may enter into a forward contract. So regardless of the exchange rate dropping to 47.80 by year end, you still have the 49.20. So in this case, you are still going to receive 4,920,000 or $100,000 times 49.20 for exporting bananas. So the last one is futures contract. Now, it's an agreement to transact involving the future exchange of assets and funds that is settled daily, less default risk, and it actually employs margin requirements and is actively traded. So in futures contract, you have here a long position is the purchase of futures contract, and we have a short position as the sale of futures contract. Now, for example, you are buying a contract which involves coffee, and then you have 10 metric tons at 1.29 per pound. Now, let's say your broker would require you to deposit $300 as a margin, and you have additional 200,000 for the maintenance. Now, what if, let's say, after 3 weeks, the price of coffee in the market went up from 1.29 per pound to 1.32 per pound. Now, in this case, okay, from a long position here, you actually gained 0.03 per pound. And if you're going to multiply that one to 10 metric tons, that's around 661.38 gains. Now, if it moved to a different direction, let's say drop by $0.03 per pound, then you will have a negative 661.38 losses. In that case, you would like to have a short position. So that's all for this video. Thank you very much for watching, and I hope that you learned something. Please do like the video, and if you want others to understand, kindly share this video. And if you need to know more, kindly subscribe so you won't miss any future videos that we're going to make. Thanks for dropping by.